David Webb. I grew up in Cleveland. You know, I've thought about how I've ended up doing this kind of work now, and I've written some about that. When I was growing up in Cleveland, we were in the early stages of this industrial collapse. So we were feeling the effects of this early. I came from a family of engineers, and Cleveland was a pretty rough place to be in the late 60s and through the 70s. And it really destroyed our world as we knew it then. And so I grew up with a deep need to understand what was happening and why it was happening. And my father was going through that. And so while I had a difficult relationship with my father, we were both kind of on the same page in terms of trying to understand what was happening. And that led to my choices in career, really. I went into business and finance really to understand that because that's how our lives were being destroyed. So I went to New York as a young guy. I ended up talking my way into a position in a mergers and acquisitions group, and that's how I got into, let's say, the inside of things. And eventually I worked in what was at that time the biggest private equity firm in the world by maybe an order of magnitude. And from there I eventually went into managing money in the public markets, equities, and then long-short equity on a big scale through the aftermath of the Asian financial crisis, through the dot-com bubble and bust. And so I developed some unusual insights into what was happening just from having to deal with that. And I did very well through the dot-com bubble by thinking differently, having a different understanding of what was happening. And I suspected that the actions of the Fed were affecting the financial markets. Now, no one would disagree with that today, but at that time in the late 90s, that was called conspiracy theory. Whenever I tried to talk with anybody about that, you've probably had that experience yourself. So I started looking at money supply figures, and I could see that in individual weeks, the amount of money, new money being created, might be 1% of US GDP. And of course, GDP is growing at 3 or 4% a year, maybe in a good year. So if you're adding money at a rate of 1% in 1 week, that's much higher than any growth that is occurring. At that time, the mechanism was through the banking system, and it was done by the New York Fed. The New York Fed is really the business end, the operational end of the Fed in terms of intervention in financial markets. So it was done through the repo market with the banks. So what the Fed would do is basically buy Treasury securities from the banks and thereby inject cash into the banks. With a low implicit interest rate on the money they had extended to the banks. So it essentially a below market interest rate. And you could see when they had they were always growing the money supply, but you could see when they were accelerating the growth of money or decelerating the rate of growth of money. And this is what I used as my signal of when they were stepping on the gas and when they were taking their foot off the gas. And so I had a lead time of maybe a few days before that started showing up in the behavior of the financial markets. And it seems literally no one else understood this. Because I had, eventually people were coming from all over the world, literally, trying to Cleveland to try to understand how I was doing what I was doing. This way of navigating worked very well through the dot-com bubble and the bust. It was often very hairy, very stressful. I've dealt with a lot of stress in life. I would have individual days where we would make or lose tens of millions of dollars a day. You know, you kind of have to go into a different place and a different way of being just to be able to do that. And I typically had over 350 positions on at a time. So it was necessary to be able to make decisions very quickly. And I would say I would do that by having a mental model of how things were working, so that when new information came up, I could understand whether this was important or not. So the key thing is most people accept information that supports their ideas. What I knew I had to do, something that fit with what I thought, I could just ignore, safely ignore. It could be used to embellish the model, so to speak. The most important thing was any piece of information that did not fit, that did not comport with the model. That's what you have to focus on immediately, especially if you're highly levered with many positions on. So the trading room, the trading desk, it was a team technique with an open, continuous discussion of what was happening and actions being taken and digging into things. And the trading room really functioned as a newsroom, and we saw everything as it happened, and sometimes it was very important to know the exact sequence of things in terms of causality. What was the real causality of what was happening? Because often what is reported in the media about the reason for something happening, it has no connection at all with what really happened or how things actually were unfolding. The trading room really being a newsroom where we had to focus on things immediately and look for, I naturally accumulated things that were the disconnects, and I couldn't ignore it because that's the way my mind works, and my mind had to work that way in order to do what I was doing. So it was really in this period after September 11th and the global war on terror that there seemed to be a massive acceleration of these disconnects. So economic data series were being changed in order to show certain numbers. And I can go through that sometime in detail about what was done there. But also many things that had happened would just fall off the table. They fell out of the media narrative, and other things were put in the media narrative. And these are all things I did not want to know, I did not want to have to deal with, but it became unavoidable for me to know that the impressions being created in the mind of the public were it was really misinformation, and this was accelerating through that period of time. So I started, while I had voted for George Bush in 2000, within a year or two after September 11th, I thought it was very important that there be a change. And I would try to talk with my neighbors. I had accumulated something about the size of a telephone book of all the things I had documented that were actually happening that were not known. And I then skinnied that down to a smaller stack that I could take door to door. And I started trying to talk with my neighbors about this. And you have probably all experienced this. I got nowhere in trying to explain things to people. Eventually, I decided to go door to door in a poor neighborhood just to see if this is how I learn about things. I learn about things by doing things. So I was trying to learn how to get through to people that the understanding that they were being given through the media did not square with the actual underlying reality. Anyway, I'll leave it there. So one of the things I saw during this period in terms of financial excess that was happening, or things that one should be worried about. In 2001, in that period of time, derivatives had reached about $100 trillion in notional value, maybe more.
What year is this?
It's 2001, 2002, somewhere in there. So at that point, it was about twice the size of global GDP. Derivatives had been created in the 90s and grown to a level that they were twice the size of the global GDP. Now, I was worried about it then, and I knew about the growth, the exponential growth in asset-backed securities, which is also related to the derivatives complex. So let me walk you through what was happening. So these asset-backed securities, it's about securitization of pools of underlying loans. So credits that have been created by the banks. So this might be mortgages, it can be boat loans, things like that. And so you have a pool of so the banks were basically stopped underwriting the risk on the credits they were creating because they would not hold these things on their balance sheet, in theory. So it became a business of originating loans, and that's why they didn't really care whether people could repay these loans. And then they were put into a pool, and this pool is stratified into tranches. If you think of it in, there's a top 20%, and there's a bottom 20%, and the tranches in between. And the idea was that any default would first hit the bottom rated tranche, and that for any defaults to damage the top 20%, you'd have to burn through 80% of the capital in the pool before that would happen. So the top tranche could be sold as AAA rated, very highly secured. The problem for Wall Street, the engineers of this, was that nobody wanted to buy the lower tranches. So they then invented the credit default obligation or credit default swap, which would allow the engineers of this pool to buy insurance protection for these lower tranches, essentially lay off the risk through a derivatives contract, and derivatives are just financial contracts. Now, when they did that, they could then sell the entire pool as AAA rated because they had laid off the default risk. Then there was so much liquidity being created by the Fed that these pools were then sold maybe 10 times over on a synthetic basis, which is also a derivative contract, a contract written on the behavior of this pool that has been originated without any risk underwriting, any assessment of whether people can service those boat loans or subprime mortgages. The synthetic is a contractual bet on the behavior of this pool. I bet that this will continue to pay a 5% yield, and there won't be a default. It's modeled on this. Derivatives are contracts modeled on the behavior of other things. So it could be interest rates or the price of tomatoes. And they were originally used for hedging, let's say, agricultural risk. There was a practical purpose for it to begin with. Well, I think it was a practical thing because you could, let's say, a farmer could sell their production forward, lock in the price at which they were selling their crops, and the buyer on the other side of that contract could lock in their cost at a given price. So these were freely entered into, they were bilateral. Now we're getting into another important subject. The pooling, so we've talked about how the key was laying off the default risk, which is also done through the derivatives market. And I wondered at the time, who is crazy enough to take the default risk on these pools that have been originated in a very flawed way with no credit underwriting? Well, we eventually learned in later years that it was the banks themselves that had set up hedge fund subsidiaries that were taking the other side on this default risk. And if you imagine this, let's say you have an enormous pool of mortgages, and you can afford the expense given the yield on the underlying securities to pay for the default insurance and still have a good yield. And let's say you're paying $10 million to someone that will take the default risk on this. And these hedge fund subsidiaries of the banks were where this was concentrated. When you run a hedge fund, typically you have a 20% share of the gains that go to the principals running the hedge fund. So the people within the bank that were running this hedge fund would get 20% of what the profits were every year. So now the beauty of this was, let's say they were being paid $10 million to take the default risk. At the end of the year, they could use their own model to show that there was no default risk because there had never been a default in these pools before. So they could then say, they could market to their risk exposure to this to show that there was no risk, and hence they could take the payment as profit. So the principals would get $2 million, in this example, being paid $10 million into their fund. They personally would pocket $2 million every time they did that. As an example, how the skids were greased to make this happen on a big scale. And then when this imploded, these bad bets were essentially covered by the Fed, by tens of trillions of dollars that were extended into the banks to make them whole on these bad bets. But this mechanism allowed the derivatives complex to grow at an incredible pace. So I said in 2001 it was about 100 trillion. By the time we were going into the great financial crisis, it was in 2007 it had reached about 700 trillion. So 100 trillion to 700 trillion in 5 or 6 years. Now at that point it was 10 times the size of the global economy. So it had been 2 times, now it's 10 times. And this is the interesting thing. The credit default obligations that enabled this, that alone was the size of global GDP. Just the credit swaps were the size of global GDP. It's not as if that is money that has been created. It is a it is a contractual value. It's a good question, but it's not as if that amount of money had been created. It is a nominal value. It is, and there are 2 sides to this contract. It's the value of the contract, and of course it has to bear some relationship to the underlying collateral that has to be extended. And I think to talk about this, we have to understand how the collateral is being used. We were at 700 trillion in 2007, so 10 times global GDP. People think that perhaps it's over a quadrillion now. Some people think 2 quadrillion. So it's given that it was at 700 trillion 16 years ago, it's probably a good bet it's over a quadrillion now.
Or a Brazilian or whatever is above a quadrillion.
A Brazilian. It's a big number, and it dwarfs anything in the real economy or any collateral that could possibly back it. It's on a fractional basis. So I've written this book, The Great Taking, and my purpose in this is to put on the table, lay bare a very sophisticated structure that has been planned. There's an intelligent design behind it. It has been planned and put in place over more than 50 years, and it is designed to take essentially all financial collateral globally, and the mechanisms are in place for that to happen. This began in the late 1960s with movement to dematerialize securities. It used to be that securities, stocks, and bonds, you had a paper certificate for that. And through dematerialization, what you have are records. You have a book entry ownership, which in and of itself did not sever your property rights. You still had property rights to those securities. They were held electronically. But this, they were in the U.S. They were held in records at Depository Trust Corp. Electronically. But then the next step was creating a new legal concept of a security entitlement that replaced property rights to securities. Your property rights to securities. So securities had been personal property for four centuries. So this was a new construct, new legal construct. The entitlement is a contractual claim. And this is very important in the case of insolvency, because if you have a contractual claim, it's very weak protection in the case of insolvency, and this is designed to be so. Associated with this, all securities are held in pooled form, and the holder of the entitlement by right or by law only has a claim on a proportionate share of what's left in this pool. Now, the next important step is that the financial system, the custodians, are empowered to borrow the securities out of the pool without any limit at all. The custodians have the legal power to borrow the securities out of these pools without restriction under, as they call it, the long-held practice of self-help. So they can take the securities out of the pool legally, free of payment. They don't need to provide anything in return for taking the securities out of the pool. Now, institutional investors are led to believe that they can have their securities segregated and that their securities are not being borrowed in this way. And that is a subterfuge. It's a deception, because their securities are in the same pool with the securities that are being borrowed, and there is no restriction on the amount of securities that can be borrowed out of the pool. And the objective is literally to use all securities in the pool. But it is clear that by law, even segregated positions are not protected in the event of insolvency. They also will have only a pro rata share of what remains in the pool. The next step is that under what's called safe harbor, which sounds nice, a safe harbor, but what that means is safe harbor for the secured creditors that have taken the client collateral out of the pools, that have the client assets as their security. Safe harbor means that the secured creditors have absolute assurance that they will keep the client collateral in the event of insolvency. And this has been tested at a high level in the courts, that this right of the secured creditors to take the client collateral cannot be challenged. And that was the purpose of the Lehman Brothers bankruptcy in the last financial crisis, in which J.P. Morgan was both the custodian for the financial assets and the secured creditor that took the financial assets. They took client collateral that they, in which J.P. Morgan was the secured creditor. So one portion of J.P. Morgan was acting as the fiduciary, the custodian for client assets, while another part of J.P. Morgan had received the client collateral, had a secured interest in the client collateral. Prior to the enactment of these safe harbor in 2005, that would have been fraud. In this case, the custodian was also the secured creditor that seized the client assets. In terms of the holding company, J.P. Morgan was wearing both hats, acting as the custodian and was also the secured creditor that seized the client assets. So this was challenged in court by the clients whose assets were taken by J.P. Morgan, because this would have been considered fraudulent prior to the enactment of safe harbors in 2005. So this was done on the eve of the financial crisis in which this was tested at a high level. And the bankruptcy court in the Southern District of New York, which is Manhattan, found on behalf of J.P. Morgan that J.P. Morgan was entitled to take the client assets under the safe harbor protections, and the only issue that they focused on was whether J.P. Morgan was entitled to take the assets, and they use this language that J.P. Morgan, as one of the largest banks, is certainly a member of the protected class. So they use those words, the protected class. What this means is that not all secured creditors are protected in this way. It's only certain secured creditors, which is essentially the very biggest banks, that will take the assets out of these pools in a large-scale financial crisis. So, we talked about dematerialization, we talked about the creation of the securities entitlement, which really severs property rights to the securities. So you can find in some of the documentation of this that and you'll hear this, the term beneficial ownership, that you are the beneficial owner of a security. And that sounds like a good thing. Everybody would like to benefit from something. But what that means is that it's really an appearance of ownership. You benefit from receiving the dividends and being able to vote the shares. And of course, you can make the decision of when to buy and sell the shares. But the beneficial owner is not the legal owner, literally not the legal owner. Legal ownership is with the collateral. The control of the security is collateral, which you do not have as the beneficial owner. That's key. It's an intentionally misleading term. You think that you are the ultimate owner because you're the beneficial owner. No, you are the person that has an appearance of ownership. It is actually the nominee that has control of the security as collateral. The nominee uses it as collateral, and then a secured creditor that has received it as collateral has control in the event of insolvency. Okay, here's an analogy to put this across, how the simple subterfuge here. So let's say you have purchased a car for cash, you have no loan, so you believe you own it outright. But unbeknownst to you, the dealer that sold you the car continues to use your car and all the cars sold by the dealer as collateral for his business. So he is able to borrow money using your car as collateral, and you know nothing about this. Then the dealer gets into trouble and becomes insolvent. And the secured creditors who have your car and all the other cars sold by the dealer as their collateral are legally empowered to take the vehicles with no judicial review required. They can do it immediately because legal certainty has been established that they can do this, and that it will only be certain protected secured creditors that have the power to do that, to take all of the collateral. And the point of this analogy, I'm not talking about cars. This is not the case with cars. It's just that people emotionally relate to their vehicles, it seems. So it puts the horror across. But it's even more horrible because this is how it works with respect to literally all financial instruments globally now, that in the event of insolvency, your financial assets that you believe you owned free and clear with no borrowings against them can be taken by certain secured creditors in the event of insolvency. And this is the shocker, not your insolvency, but insolvency of the people that secretly used your securities as collateral. So, first of all, you had to have the dematerialization so that there were no actual certificates and specific identification of a owner to a specific security. So you had to have the pooled nature, electronic form. But then the beginnings of this was with changing the Uniform Commercial Code in the United States. And it was specifically Article 8 and 9 of the UCC, Uniform Commercial Code. The Uniform Commercial Code is basically business law, recommended. It's something that's determined by industry. So it's a body of law that is enacted at the state level, and that's why they did it this way. There's no exposure of this at the federal level, congressionally. It could be done working with state legislatures, and it took many years to put this in place, but the amendments were made in 1994, and then they had all this in place in all 50 states, we know, by 2006. So it took some time. I don't know if it was enacted before that, but we know this because after this structure was put in place in all 50 states in the US, there was a global push to harmonize this, all law globally, to conform with this model, so that all financial assets globally would be under this structure and could be taken in this way by the secured creditors. So in Europe, so it's first done under the Uniform Commercial Code in the US, then in Europe, they formed something called the Legal Certainty Group to study how to do this in Europe. And what they mean, again, legal certainty sounds nice, but what they mean by that is making it legally certain that the secured creditors can take the client assets without being challenged legally. So this legal certainty group sent a questionnaire to the New York Federal Reserve Bank asking how to do this. And going through it in detail. So we have this document which is absolutely irrefutable proof that this is all true, how this works. So this is not conspiracy theory, it's not conjecture. This is how you can come to know things, by finding primary source documents from the actors themselves, their own plans, and how they have structured this and their own explanation of it. So we have that in a document prepared by lawyers at the New York Federal Reserve. This is what the Europeans had to do to circumvent European law to conform to this model. So the Fed document explained the pooled structure and the fact that, for example, segregated holders that believe that their securities have been segregated are absolutely not protected in the event of insolvency because of the pooled nature of the holding. They still have only a pro rata share. They make it clear that even in the event of fraud or negligence, that the entitlement holders only get a pro rata share. Even in the event of fraud, they only get a pro rata share of what's left in the pool. It's shocking when you look at this. By instituting the safe harbor, which makes it safe for secured creditors to take client assets, even something that was previously considered fraudulent. It's legalized fraud. It was previously fraud, and now it's not. And it is done without any consent, no one really knowing that this is how it really works. Even people who believe that they are sophisticated institutional investors do not understand this. They believe that their securities are segregated. They are ignorant of this. So all pension funds, for example, are exposed to this. So let's talk about Europe. So Europe had the EU, at the EU level, they accepted this objective to create legal certainty for secured creditors to take client assets. It was done from the highest level of the EU. This push to force harmonization of this globally was literally run from the State Department, which is the most powerful executive power globally, the U.S. State Department. So this has been done from the highest level of government. Why is that? Because obviously the secured creditors that are taking the client assets actually control these governments. These governments work for these interests, these secured creditors that are taking the client assets. So in Europe, they had to subvert national law that protected property rights to securities, which has been considered a sacred thing, property rights. CSDR, Central Security Depository Regulation. It's an EU directive in 2014. So you see the beginnings of this. The Legal Certainty Group is asking the Fed how to do this in 2006. It took until 2014 for them to actually implement CSDR to make it happen in Europe. And the way it works is that you have a central security depository at the local level, the national level, which is the record of beneficial ownership. But then under CSDR, there's a mandatory linkage from the national CSDs to an international CSD, ICSD, and that provides for passing the title to the securities up to the international level. It doesn't stop there. The purpose is that that collateral is then passed to the central clearing counterparties, which is where all of the derivatives risk is now concentrated. Now, derivatives used to be bilateral, meaning there were two parties, and there was a construct, a rationale that was risky. So we have to have a central clearing for all these things, so that when you enter into a derivatives contract, there's not another party on the other side. It's the central clearing counterparty that takes the other side. So this is then a monolithic risk that is concentrated in these central clearing counterparties, because that entity stands in the middle on all derivatives contracts, which are now in total globally well over 10 times the size of the global economy. So this created the rationale, this imperative, that all collateral, every scrap of available collateral had to be made available to underpin this derivatives complex, or everything will collapse. So they create a vulnerable situation in order to justify a system that hoovers up all of the client collateral into these entities. It's the too big to fail argument taken to a global level, requiring the near instantaneous transport of legal title to all financial assets into these central clearing counterparties, which are in turn set up to fail. And the people in that industry are in print, this is documented in the book, talking about the very real possibility that these central clearing counterparties can fail. And we can see this discussion both in Europe and around Depository Trust Corp in the U.S. So you can see the financial statements for Depository Trust Corp, which is the central security depository for all stocks and bonds in the United States, in the U.S. financial system, and also the central clearing party for derivatives contracts. And they have set up plans to start up a new central clearing party when this fails, if they have a failure, if they have a collapse. So they're actually preparing for a collapse by not putting in more collateral to prevent the collapse, but to assume that the collapse happens and they will then start up again, and that is pre-funded. The new central clearing counterparty is pre-funded. The present capitalization under essentially the entire securities complex of the United States is $3.5 billion. This is Depository Trust Corp. DTC is, yes, is essentially owned by the industry. I believe so. This is, the design behind this is, it's remarkably intelligent. And it has been executed with persistence over decades. So this is absolutely no accident. You can see where it is going. And I believe the intention of the planners and the architecture of this was set in motion over 50 years ago. The intention of the planners was total global subjugation. That's what this is about. It is, as I say in the book, it's not that they need your stuff, it's not that they want your stuff, as it was not in the 1930s. They don't need your money, they can create unlimited money. It is about subjugation of people. So we're in a global hybrid war. This is really the objective. The other things we're seeing are tactics in this global hybrid war, but this is the end game, is collapsing this and taking everything. Yes. I think he's obliquely referring to it. If you go through this and understand it, it's unavoidable, an unavoidable conclusion. And it's my purpose here to, this has never been examined, this has never been exposed, by pulling this out on the table so that awareness of this can be pushed all the way up the food chain, so to speak, to the top of the system. if we can all understand that this mechanism is in place, we can have some conscious decision about what is our relationship to this, what should we do with it. And I believe that the hope here is that the people that have been facilitating this will realize where it is going and choose not to continue facilitating this, and that even the people who are the heirs to this control position of the central banks and the largest banks, that I think it's important to realize they're just people. You know, they're not lizards. They're just people. They are in a very real way as trapped in this as we are, this design. And it does not have to happen. It is a construct. This is artificial, and it can be dismantled. I think I went through years trying to understand this and trying to figure out how to get out of harm's way. Because that's one of the, I knew that the best analogy for the time we're in is the period in the Great Wars and the Depression. And one observation from that is that you couldn't really know where was going to become a very bad place to be. So you had to have the flexibility to get out of harm's way, and I felt I had that responsibility to my family to understand that. But I've ultimately reached the conclusion that you can't hide from this. It's reached that level because this is, in the 1930s, it was about debt, people in debt losing everything. This has progressed to a design to take even the, all of the financial support from people who have no debt, people who believe that they own things outright. And the intention is to make it so comprehensive that we will be in something like feudalism, of course, but we're in a hybrid war that is open-ended as well. So it is open-ended geographically, it is open-ended in terms of time, and it is also inside of our heads and now promises to be inside of our bodies. You know, it's in our minds, and their objective is to get into our bodies as well. So there will be no place to hide. And so I have to be all in to make this apparent